Welcome to the daily update, where I'll go over the action in the market for Thursday, October 10th, and then we'll see how things look for Friday, October 11th. For this anticipation that CPI was coming out, it ended up being a real dud of a day. We were down slightly. We're still looking positive. We have PPI coming out on Friday, but we continue to be below average with volume. There's just not an awful lot of conviction. If anything, we're still remaining positive. We're not really seeing any selling into strength. We still have these warning signs that are coming from the VIX, but it doesn't seem to get settled for right now. So we're kind of in the same situation that we've been in now for the last number of days. So please be aware that I do have a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. You can get to the website by clicking on the link below this video. You can also check out another video that talks about the program. If you have any questions, you can certainly email me about that. And one of the benefits is you get immediate access to the videos as they are posted. And the daily video is the main video for what I do, and all of the other videos, which I'll be preparing over the weekend, those are meant to supplement the daily videos. Okay, let's go back and talk about what happened and look at some charts. We did have a lower open and prices chopped above and below the daily pivot at 57.78. And then we were able to climb to resistance at the unchanged level. So we were negative. We came up. We actually went a little bit positive. But on a down day and we start going up, the unchanged level is another overhead resistance area. Just like on a down day, it's a support level, or excuse me, on an up day, it's a support level. Then we were able to decline back down below the daily pivot before climbing back to close slightly above the daily pivot. So the daily pivot was kind of where things happened in Thursday's session. We were down 0.21% and we continue to be below average with volume. We are still positive in the short, intermediate, and long term as measured by the moving averages. It came in a little bit hotter than expected, and the market didn't really like that. We're still seeing the 10-year yield continuing to go up. The dollar is continuing to bounce, and those are putting some pressure on stocks. And we want to keep an eye on the geopolitical events, specifically between Israel and Iran. Now, Friday, let's see, it's Friday evening where I'm at, and I'm in the same time zone as Israel. That begins Yom Kippur, which is the holiest day, the most important day of the Jewish year. It'll be at a different time if you're in the US, but this happened back in 1973. That's why we call it the Yom Kippur War. So we're wondering, is anything going to develop over this very important day? It would be like in the US being attacked on Christmas Day or something like that. I mean, usually it's a day when people are with their families, there's no real work going on, and the focus is in a different direction. And we'll just have to see if there something happens because of the day that's unfolding here. Okay, so some comments. We're still watching things in the Middle East. Oil did climb back up a little bit. It had been dropping. Now it's around the 75 level. On a short-term basis, we still have the Williams percent R that's looking extreme positive, as well as the CCI 14 and 20 and stochastics. And you could say overbought, meaning that we've gone up too far too fast, but we've been at this level now for a few days. And really, this is just showing more that the market is holding up in the short term. And plus, we're above the moving averages as well. Intermediate term, the PMO studies, they've been there for quite a while, also suggesting on an intermediate term basis, the rest of the stocks in the S&P, excuse me, are holding up for the time being. The Sean trend meter really kind of bounced up a little bit and is looking pretty extreme right now. The bullish percent index for the S&P also showing good intermediate term strength in the S&P, and then the 10-day new highs, new lows for the S&P 500. All of these taken together, we've been at this level for a while, are just suggesting that the rest of the stocks in the S&P are holding up, even though we're not really breaking either to the downside or the upside. So we want to keep an eye on these indicators, especially if we start moving down, to see if some weakness is starting to come in. We're still looking good on a long-term basis as well, where we're above the extreme reading that we have for the 150 and 200-day simple moving average. And the scenario really hasn't changed, even though inflation ticked up a little bit. The CPI was hotter than expected, and I'll go through that. It hasn't changed the overall scenario that we are going to have a soft landing, which means avoid a recession, at least for right now, but that could change. The dollar was up and interest rates were up. We're back to 4.1% with the 10-year yield, where we had been at 4.06%. We're still inverted with the 10 to the 3-month yield curve. We're still uninverted with the 10 to the 2. That has not changed. Sentiment ticked down a notch because of the slight down day. We're at 71, which is still positive, where we had been at 72. We are still positive with our trend. The ADX is still above the moving average, and it's still positive with the green line on top. And the bias, I probably should have changed that to negative with the slight down day. I didn't update that part, but we're still mixed to positive in the more momentum phase, where I take the last 2, 3, 4, 5, 6 days together and just kind of say, okay, what are we looking like overall with that? We did get weekly initial claims, which came in higher than expected at 258,000. They expected 229,000. Last week it was at 225,000. So this is a little bit of weakening showing in the employment area. Is that going to matter? Is this just an outlier? Does any of this have to do with the hurricane, the first hurricane, and now the other hurricane that's been hitting the US? Is that going to bump these numbers up as well? And how is the market going to interpret that? The continuing claims also went up to 1.861 million. Last time it was at 1.819 million, and it was actually revised from 1.826 million. CPI, this did come in, the headline number, more than expected, up 0.2%, where they expected it to be up 0.1%. Last time it was up 0.2%. The core CPI, that's the important one that folks watch. It also was higher than expected, up 0.3%. They expected 0.2%. Last time it was up 0.3%. So looking at this, we saw a real spike up here with the weekly jobless claims, enough to turn the moving average back up. We had been taking a little bit more comfort in the fact that the moving average was still going down. And that just shows that the employment situation is holding together for right now. Well, with this spike up, the moving average is now beginning to go back up. But we're still at pretty low levels overall. I don't show a long-term version of this chart because you've got the COVID stuff in there, and it pretty much destroys looking at this chart. It becomes so skewed. Continuing claims also went up, and we're starting to go back up with the moving average. So we want to keep an eye on this to see, is this just an outlier, or is an actual trend starting to develop where we're seeing weakening in employment? So we came down with the unemployment rate, which when the employment situation report came out, spiking up here with the initial claims and also going back up with the continuing claims. Then CPI on a year-over-year basis, it's still showing a decline here, but month over month, it's still looking positive. And the core CPI also flattening out on a year-over-year basis and going back up on a month-over-month basis. All right, then looking at household equity ownership. This is folks specifically in the US that own stock. And when they own stock, how does that compare with the S&P 500? And it's still giving us a pretty high reading as the S&P has been going up. And this is the percent of their financial assets. It's also starting to go up and break out here. And folks are still seeing the stock market as quite attractive at this time because it's setting new all-time highs and holding up quite well recently. Then this is where new highs in October are a good sign. This just goes back to 1954 and says, okay, when the October return, we don't know what it's going to be yet, but the average is 1.4% with the median being 2%, and then we're up 75% of the time. And then you look at the whole fourth quarter together, October, November, December, where we see an average and median return of 5%, and we're up 90% of the time. And you can break it down a little bit further here, going from 1950 to 2023, just to get a comparison. I mean, the returns are still pretty good on a quarter over quarter basis, but they tend to be better when we hit all-time highs in October. Then earnings season has historically been positive for stocks, with the S&P rising an average of 2% in the first 4 weeks of reporting. We did see during the second quarter here a bit of a drop down at this point here, and then just different events that have happened. But trying to follow along because we're just about getting ready to go into earnings season that will really have an impact on which way the market ends up moving. And these are the earnings per share cuts, and that's very common, where the historical average, that's yellow, where as we get closer and closer, the folks that do these projections, they have to get more and more potentially realistic with things. And we look at how the cuts were happening in 2024, and we're even seeing a little bit of a cut looking out into 2025. And then they have to take out COVID and the great financial crisis in the year 2000 just to manipulate things to make it look the way they want it to look here. And then this is the scenario that I've been putting forth now is why is the Fed coming in and actually cutting rates? Is it because the economy is falling apart? No. It's because inflation so far appears to be coming down, and just to help stimulate the economy so the Fed can come in and try to tweak and tinker with the economy a little bit just to help it continue to grow instead of it being some kind of black swan event or something catastrophic. But we're coming into a very interesting time now with the presidential election. No matter how that turns out, then you have that window of time from the time of the election, and we'll see when we get the results. We used to get them right away, but with this advancement of technology, now it can take weeks. Isn't that interesting? But then the window from the time, because there's going to be somebody new as president. So what's going to happen from November until January 20th when the new president actually comes into office? Are some really weird things going to be happening? We also have the holidays around that time. So this can all change. We can only go with what we're seeing right now, and it's looking like the cuts that the Fed is doing, it's more just to help the economy along, and that's more advantageous, and stocks can go up in that kind of an environment. Okay, this is the credit spread. This is the chart that I show. I was showing it every day, but we're getting such a low reading right now. I dropped that out of the daily video. I will be showing this over, but it's just showing the spread between risky bonds and not as risky bonds. A little bit different here, but it's just showing that there's just not an awful lot of fear right now. And then the cash allocation, we're down at 11%, where the average is just a little bit over 12% for the Bank of America. So a lot of the money is in the market right now. And then this is the move index, which I also go over in the weekly videos. It's really spiking up as bond prices have been going down and interest rates have been going back up. And this is core CPI. Now, this came out, these are the different components that make up the report that came out, but this was released before CPI was actually released. So if you want to see the different components that go into CPI and core CPI, you can pause this and look at that. And here's kind of a scary line, just looking like a bunch of weirdly weird spaghetti. And just looking at the rolling year-to-date performance from 2000 to 2024 and where we're at. And we're pretty much still at the top as far as performance compared to the other years. Let's see, didn't really spend any time on Twitter. So we did have a lower open here down right at the daily pivot, and then we spent the initial opening part of the day below the daily pivot, then came back up, then went down, then broke up, and it looked like, okay, maybe we're going to bust through to the upside. We actually got a little bit above the unchanged level, and that's about as good as we were doing there. Then we fell back down to the daily pivot, dropped below the daily pivot, came back and closed just a little bit above the daily pivot. And seeing things pretty quiet in the initial overnight session right now. And this is still looking better with the blue line above the red line. So on an intraday basis, growth is still doing a little bit better than value. And that's what we want to see in a more positive environment. We're also still looking pretty good here with our growth to value ratio intraday for the S&P. We bottomed out right around the beginning of October, and we've been going up for the most part overall, and that is encouraging. In our end of day charts, where growth was down, but down less than value, it was down more for the mid caps and more for the small caps. So we came down a little bit, not really showing any strength here with small cap growth to value. Mid cap growth to value, a little bit of improvement, but still in a longer term downtrend. What's a little more encouraging for the S&P is that we're still holding up with the growth to value ratio here. And we're still in the middle of the rainbow. We're not seeing a real breakout yet of growth versus value when we look at these two different ETFs. And came down a little bit, but discretionary to staples also looking pretty good right now. And it's not that discretionary is doing all that great. It's that staples have been under pressure lately, and that has been helping this ratio to go up. Large cap growth still looking pretty good here. As far as our trend, we're still above the moving average and the green line is on top and we're above 20. So we're in a confirmed positive trend. It's not really all that strong yet, but at least it is positive for right now. And we're seeing a little bit more of an improvement here with the short-term chart going above the moving average and the green line. I know they're all pretty much on top of each other right here, but short and intermediate term still continue to be positive, but we continue to be below average with volume. And we're still above 20 with the VIX, both with the line chart and the bar chart. The VIX of the VIX is also still above the moving averages here with the bar chart and the line chart. And the momentum of the VIX still continues to be up. And here's the historical chart, which also suggests that there could be more upside with the VIX right now, at least on a historical basis. And we're still getting a high reading when we look at the correlation between the VIX and the S&P. We're above the dashed line. That means the market is getting nervous, even though the stocks are holding up for the time being. And the skew index, which looks at out of the money options, it's still up into this red area where the market is expecting some kind of a big move that, at least for the last week or so, just hasn't happened. And we're wondering if it's going to develop at some point. We ticked up a little bit with this fear gauge. We also ticked back up just slightly with this other fear gauge as we had the slight down day. We're still tending to go up overall when we look at risk on versus risk off. When this is going up, folks are preferring the high beta stocks like Google and Apple and so forth. And we really declined here with the daily chart of the equity put call ratio. So we're coming down with the 5-day and we're getting to that extreme negative reading. And this is to give it a little bit more context. This is a longer term look. When we get below this level, we could, at some point, this tends to bottom out, and that could end up being actually negative for stocks, but we could still go lower than where we're at right now, where the 10-day average is still continuing to go up. So we're seeing a little bit of contradiction there. The volatility risk premium still giving us quite a high reading, meaning that fear is coming back into the market. We did get the latest reading of the American Association of Individual Investors at 28.4. They're still below that 30 level, but still looking rather positive for right now. So just kind of hanging in there with the advanced decline line based on price and looking a little bit better here, even though we were flat. We did break out, at least in yesterday's session, with a new high with the advanced decline line based on volume. So volume is still looking better than price right now. And we saw a drop off in the new highs, but they're still outnumbering any kind of new lows. We're going sideways with the 5-day and we're flattening out with the 10-day. The accumulation distribution smart money indicator came down just a little bit, but still looking positive as it's above an advancing moving average. Still above zero with the advanced decline ratio. So we're above zero based on price and volume. And you can see volume's holding up, just that we're getting a little higher reading with volume. So it's looking a little more positive. This is a bit of a concern. We're continuing to decline with the histogram with the Chaikin money flow, and the red line continues to decline. And we're pretty much flat again after we were starting to go back up with the Chaikin oscillator. The vortex is still looking a little bit better with the green line going up and the red line going down. And this is another part where we're looking a little better based on volume. We look at the S&P cumulative advanced decline line based on price, where we're just kind of chopping sideways. We're actually breaking out a little bit here based on volume. We're seeing a little bit of a disconnect between the S&P doing better than the NYSE advanced decline line. And the new highs, new lows continue to be positive for the S&P, but we're still going down slightly with the 50-day. Here's another breakout of that same chart. Still looking good with the 10-day average of the highs and lows for the S&P, getting a very high reading, suggesting longer-term solid momentum. And then we look at the cumulative advanced decline line for the NYSE, just kind of chopping along here, not really breaking out, but not really breaking down either, where we're seeing things kind of level out after slightly declining with the regular NYSE advanced decline line. This other NYSE advanced decline line has been under a little bit of pressure lately. Here's the common stock for the NYSE actually pulling back as volume has been holding up better. So we're seeing volume more solid with the S&P across the entire index and on the NYSE when we just look at common stock. The new highs, new lows continue to be positive for the NYSE. The 50-day is also continuing to decline as it's seeing weakness, but it's still positive since it's above zero. We're also above zero with the 5-day moving average across the broad market. And coming down a little bit, but still above the moving average with the NYSE common stock, S&P mid caps. We're coming back down to the moving average with the small caps. Still having a tendency to go up overall when we look at the ratio between large caps and small caps. And it's not that large caps had a good day, it's just small caps had a bad day. And coming down, but still above 50 with those stocks in the S&P above their 20-period moving average, 50-period moving average. We're flat with the 100-period moving average steady and declined slightly with the 200-period moving average steady. So here, not really doing much after setting that all-time high and just continuing to drop off with volume. We ticked down a little bit with the 20, 50, and we're flat with the 200-day moving average on the S&P. Above the midpoint, but did decline with the Stochk RSI. Coming down, but still extreme with the Williams percent R. We're looking extreme with the CCI 14 and the CCI 20. And coming down, but still extreme in the short-term stochastics, going into extreme in the intermediate terms, short-term stochastics, and turning back up above the moving average with the long short-term stochastics. Decline, but still positive with the force index. We're still coming in right at about the lines here with the condition of the 20-period moving average. Here is the 20-period moving average, simple and exponential. We're still positive in the short term. And I'm not even showing the 50, 100, or 200s very much right now because we're above the 20. So we're still looking good across the board. Came down, we're still at the lower end of the +2 channel with the standard deviations chart. So looking at the intermediate term, still above zero with the balance of power, still above the red line and the blue line with our 50-period moving average. The go, no go continues to be positive. We're still coming up to the highest high value and above the midpoint with the highest high versus lowest low value chart. But the TTM squeeze continues to drop off and is looking more negative. We're still above zero with the ease of movement and pretty much flat, but getting a high positive reading with the Erin indicator as measured by the oscillator. We decline, and this is a bit of a concern. We're still below zero with the S&P McClellan oscillator. So we're continuing to go down based on price. We were starting to go up based on volume, but now we've flattened out a bit here. And we're below zero with the NYSE McClellan oscillator. So we're declining based on price and volume. But you can see how volume's going down with more intensity. Price is going down with more intensity than volume. That could end up being positive. And we're trying to work our way back. This is actually a bit of a surprise. The Swenlin trading oscillator came up. We're still negative, barely, but we bounced off of zero based on volume and are looking a little more positive. So this could be positive for the market. Momentum just kind of chopping around its moving average with the PMO. We're negative based on price. We're flat based on volume. So not really seeing much of a change with the PMOs that are rising, flattening out with the buy signal, still extreme with the PMOs inside the S&P that are above zero. And we continue to be positive with the Elder's Impulse system. We're continuing the second day now being positive with the parabolic SAR with the dots underneath. We're no longer extreme and looking more negative in the short term with the slope oscillator, trying to turn back up with the MACD and looking a little more positive there. So looking more negative with the slope, trying to turn back up with the TSI, that's the short term. The MACD is showing an improvement. The PMO and PPO are also looking a little bit better, coming down to the moving average with the tricks and starting to drop below the moving average with the KST. So we're getting a mixed picture across the different time frames right now with our momentum. And we are negative with the Copic curve momentum oscillator. And here's where the Sean trend meter just broke off up into this extreme reading, even though we had a slight down day. We're above 50 and advancing with the money flow, above 50 and advancing with the ultimate oscillator. On balance volume is still positive. It's above an advancing moving average, still above 50 with the RSI 14 and 9, even though they both declined slightly, still above all the plotted moving averages here. Still getting a very high reading, but not really breaking up or breaking down yet too much with the bullish percent index. Now, you could default more to negative since overall we've been coming down lately after getting a really high reading here, but it's not changing all that much, at least yet. Came down a little bit, but still looking solid with the NYSE bullish percent index, and we're pretty much flat, but still positive with the NASDAQ 100 bullish percent index. And just looking at the long-term chart to get a better perspective on things, we're still looking good. This is a weekly chart of the S&P, and we're well above this R2 pivot level. And looking positive from a trend basis with the hike in ASHI, the KEGI chart is black and pointing up. That's positive. The Renko chart is positive, and the three-line break is looking a little more positive now. And still above the red line here with our 150 and 200 period moving averages. So those are showing good longer term momentum. And we've been seeing that for the most part in 2024. We've spent most of the time above these red lines here. We had some pullbacks there back in the spring and in the summer, but this is just suggesting good long-term momentum. We're negative with the small caps in the short term, but all the other indexes are positive on all different time frames. Negative with the short-term price of bonds, and negative with the long-term commodities, and negative in the intermediate and long-term with the dollar. And we had energy and materials that were up. All of the other sectors ended up being down, with the real estate getting hit the hardest. And we did have the NASDAQ chopping around. First, it went below 18.2, then above 18.3. Canada seems to be doing pretty well, setting a new all-time high, and discretionary had a BPI cross below 70. We've been more encouraged about discretionary lately. Are we starting to see some weakness there? And then Tesla came out with their robo-cab or something. That's kind of interesting. Not really seeing much of a disconnect between the weighted version and equal weight version of the S&P. A little bit of an improvement here, but really chopping around when we look at a ratio between the two. The Dow was down slightly after recently, just yesterday, setting an all-time high. Still positive with the Elder's Impulse system for the diamonds, and down slightly with the NASDAQ, but still holding up fairly well there. And also the NASDAQ 100 was down slightly. The Qs still remain positive with the Elder's Impulse system. The momentum is trying to turn back more positive here for the NASDAQ 100. We've gone from positive to negative with the small caps. They were down over 0.5%, coming back down and testing their 50-day moving average as well as this pivot point. So far, those levels are holding. When we look at the Russell 2000 small caps, dropping below 50 with the RSI, still above the 50-day moving average, but the momentum is negative. And we've gone from positive to neutral with the mid caps with the Elder's Impulse system, just chopping along sideways, not really going anywhere. Not setting an all-time high with the Wilshire, but down 0.21% after setting an all-time high yesterday. And also setting an all-time high yesterday with the total U.S. stock ETF, but it was down slightly here, but still holding up quite well. We're still declining with the staples to tech ratio. That could be positive for the market to go higher, but we're still seeing an overall uptrend of staples compared to tech with this ratio. Financial sector was down, but still looking pretty solid there. The FANG index was actually up 0.76%, but not back to an all-time high. We're coming back up to the shorter term trend line. We'll see if we were able to break through that or if that's going to cause overhead resistance. Apple was down 0.22%, but still above its 50-day moving average. Amazon was up 0.8% after coming back down to its 50-day moving average. Microsoft still wondering if we're going to see a death cross here, just barely hanging on to being positive for right now. It was down 0.39%. Google was up, and a lot of the action. I'm sorry, I'm thinking of Tesla, but coming back down to its 200-day moving average, and so far being able to stay above that. Meta was down over 1%, but still looking pretty solid. Nvidia was up 1.63%, but not setting a new all-time high. This is Tesla, where it was down almost 1%. And then a lot of the action has been happening in the aftermarket hours. We'll have to see how that carries over into the day session. And Netflix was up 0.39% and still looking pretty solid there. Seeing a real drop off when we compare US to world stocks on a short term basis, still holding up fairly well with the longer term correlation there. Oil went back up into the 75 range now, and the dollar is still in a downtrend, but it's been really bouncing up after it came back down to this 100 level. And we're continuing to go up with the 10-year yield, so we're going down with the 10-year based on price. And seeing things okay here with the Qs to S&P ratio. Discretionary to S&P is now showing some weakness. Even though the discretionary to staples ratio is going up, that's more weakness in staples. When we compare it to the S&P, it's not holding up as the way it had been. And we'll have to see again, what is the reaction from this Tesla RoboCab or whatever that's called. We're still looking better here with large cap growth versus large cap value. So the large caps, mid caps showing some improvement, and small caps declined after breaking out slightly with their growth to value ratio. Still tending to go down overall with the S&P to utilities ratio, even though it went up over the last couple of days. This is encouraging, though. The staples to S&P 500 ratio continues to decline, and that's more positive for the S&P. And then really nothing to show here other than the date change with the Hindenburg almond. Still waiting to see if there's another confirmation signal. So what's our outlook for Friday? We are still positive. We have this Hindenburg almond and weak seasonality that hasn't seemed to be of any concern to the market, at least yet. But we do have these multiple VIX signals that are flashing, but they've been flashing for a number of days now, and the market really hasn't changed much. We're going to get PPI on Friday as well as consumer sentiment. We'll see if maybe the market can get some conviction based on these reports or something that happens. And then watching the geopolitical things going on as well. So here is the finishing up of the economic calendar for the week. Here's also looking at what they're expecting for PPI on Friday. Seasonality, we're negative with the Dow, we're neutral to negative with the S&P, neutral to positive with the NASDAQ. So we've kind of scan the whole board there of possibilities. We'll be on the 9th trading day of the month where we do see some positive seasonality for the S&P with the green dash line during an election year. Friday is a positive day based on what happened in 2023, and it's the second most positive day so far in 2024, but we're just not really following seasonality, at least to this point, to what typically will happen. So we still have the confirmed Hindenburg almond as well as weak seasonality. We're watching the more defensive areas of the market to see, is that a concern? But we've been watching that for months, and it really hasn't mattered all that much. We're watching growth of value, which is still looking fairly good for the S&P 500. Discretionary to staples. Again, it's more weakness in staples, where discretionary by itself hasn't been doing all that well lately. We're watching these VIX signals to see if they're going to mean something at some point. And the 10-day equity put call ratio is going up. And we're still negative with the S&P and NYSE McClellan oscillators and summation indexes. And we're seeing a divergence here with the Swenlin trading oscillator. We're positive based on volume, and price is negative but improving, just barely negative for right now. And our oscillators, we're seeing things kind of shifting. Some are showing some improvement, some are looking more negative. We're not really getting any kind of coherent across the board reading with our oscillators right now. We're looking okay, but showing some weakness with our smart money indicators, the accumulation distribution, Chaikin money flow, Chaikin oscillators now back to chopping sideways, but they're still positive overall for the time being. And we're getting extreme negative here with the equity put call ratio. Now, it could still go further than that, and that would tend to be positive. The advanced decline line still holding up. We're extreme with the S&P bullish percent index, still looking positive with the NASDAQ 100 and NYSE bullish percent indexes. And we're back to positive with the parabolic SAR, the vortex, the money flow, the ease of movement, ultimate oscillator, and the momentum is turning back a little more positive with the NASDAQ 100. The financial sector is still looking positive as well. So our conclusion, no change here. We're positive, but we have these potentially crazy things that the perma bears just love that aren't really doing anything right now. But we also have a real potential of geopolitical events as well as election type events that could erupt at some point and actually have an impact on the market. We're still positive, but a little bit extreme with the short term, still looking positive with the intermediate term with the VIX signals, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.